When you look at ETF flows, it really shows a mixed picture. And you see investors really on the sidelines to some degree, looking for the outcome of all of the trade deals that we anticipate here coming over the next weeks and months. And also, even more recently, because of the U.S. Downgrade as well, you see investors also sort of taking a wait-and-see approach. So when you look at those flow data, certainly there is some buy the dip, and some of that money has just started to come in off the sidelines for risk assets.
Can I ask about some of the negativity? You mentioned the U.S. sovereign debt rating and some of the concerns around the fiscal position. That is lurking there, but we didn't get a wild reaction like we've had previously when ratings agencies have reacted. There's one factor. The other point around whether we can truly skirt any trough in the economy with some of the investment decisions that have been put on hold and some of the tariff uncertainty. Those are the big negatives. Are they at all priced into any of the ETF positioning?
It doesn't seem like that yet. I think to a large degree, it was anticipated. And so the reaction was relatively muted in terms of the flow. And again, we did see a little bit of cash come back off on the sidelines. But one of the other themes that we see, at least for retail investors, is the increasing trend towards using actively managed ETFs, which is something that's relatively new to the market. So this is investors who aren't really sure how they want to tactically position and are more willing than ever to use ETFs to have professional management. And we saw those flows continue to tick up last year and into the first quarter this year.
So can I just unpick that versus doing it themselves, for instance, which they would have done before? They would have just bought a well-known ETF.
Correct. I mean, ETFs basically since inception have been really synonymous with passive investing, major benchmarks, which is still the case. But what we've seen is actively managed ETFs continue to come into the market. Just last year and through the first really 4 months of this year, we saw record new issuance of ETFs, and we see the number of actively managed ETFs continue to increase, and some of the flows have continued to go that direction as well. So, here we are, in 2025. Again, active is a long way to go to beat those passive benchmarks in terms of assets and flow, but the market is slowly trying to catch up, and now it's about 7% of the market and growing quickly.
Ben, talking about new ETFs coming to market, over the last few months, we've seen a couple of private credit ETFs come to the market, and there's been a lot of debate, concern as to whether it makes sense to be wrapping up private credit in the form of an ETF and selling that then to a retail investor, what is a pretty sophisticated and illiquid asset class. What are your thoughts, and what have you seen in terms of appetite for some of these private ETFs?
Yeah, ETFs have always been at the forefront of innovation, and you're seeing ETF issuers really push the boundaries. So private credit ETFs, a great example. You see a lot of innovation. Clearly, there's a lot of demand in the market for these type of strategies. We've seen that in private funds, right, that are holding private credit. But ETFs are obviously an attractive wrapper, but there are some constraints, of course. The ETF wrapper can only take you so far, and it does have daily liquidity. And so when you look at putting assets in there, you really need to be mindful of what's inside. So we encourage investors to do their homework, to really understand what's in the portfolio, the liquidity constraints, and really the overall exposure that investors are getting.